So today's topic is actually, in some sense, a little bit more, well, I wouldn't say it's just interesting for people that trade in institutions and make bigger money or manage bigger funds, because it's sort of everywhere, but it's definitely more helpful there. However, actually understanding this topic is extremely powerful in terms of how you can tailor your trading strategies to do things. And it's a bit of a heavy topic in terms of math, so all I can do today is really present the basics. But if you have any questions regarding specific things, I'm more than happy to answer them. As I said, the math is complex, and I'm not going through that today because I don't think it really adds much to the interest. What I really want to do today is show you some interesting aspects of this optimal execution and what you can do, or how you could use it, or how can you see it in the simplest possible way and possibly leverage it for your own trading. So I'm actually going to show you as well some of my own personal results from this. So it's basically called Almgren-Chris Optimal Execution. Now, the paper I'm presenting today is probably one of the landmark papers in trading itself. So it's quite old, and it's written by two big guys in this called Almgren and Chris. Almgren is probably the main man, although I don't want to tread anyone's toes here. They're extremely well thought through researches, and I find it super interesting. And so without any further ado, I just want to dive straight into it. And what they say here is, in the introduction, we consider the problem of portfolio liquidation with the aim of minimizing a combination of volatility, risk, and transaction costs arising from permanent and temporary market impact. So what this means is, when you do a trade, and specifically when you do large trades, so let's say you work in a hedge fund and you want to do a trade over several millions or tens of millions of dollars, inevitably you will have some market impact. So meaning, when you do the trade, you just lift the market up if you're buying, or you push the market down when you're selling. So the question is, what can we do in order to reduce and minimize the impact of our trading? Now, when you trade large stocks, for example, then you might need like at least hundreds of thousands or millions of dollars to move the market in a significant way. However, if you trade small caps, or we're here in Australia, and there is actually also a lot of small caps, quite a small volume will suffice to actually produce a significant market impact as well. And the question is, first of all, how can we understand this? How can we understand market impact? And the second question is, what can we do to actually minimize the impact of our trade and therefore reduce the costs of our transactions? And so there's really two risks when we do this trading. And one is, of course, the transaction costs that we incur. So the price of our transaction that basically reduces our profit and loss. And the other one is volatility risk. So when we move the market, we're not going to get executed at the prices that we ideally want in many cases, which means that this has an impact on our trading strategy overall, because if we have less reliable trading going on, then our strategy will inevitably suffer. So we want to also see if we can reduce the risk of price volatility. And when I say price volatility, it's the volatility of the prices at which our trades get executed. So the first thing I want to quickly talk about is market impact, or the trading objectives that I mentioned. So market impact is basically, when we execute large trades very rapidly, we get the costs because we move the market. Now, this is obviously true if we run market orders. And in fact, this paper speaks specifically about market orders. Now, you could say, well, but we could actually do limit orders. And of course, there is also more theory, not in this paper, but in follow-up papers that actually do talk about limit orders. However, the complexity starts to increase even more, so we are not going to cover this in this session. Now, the volatility risk, basically, if your trade is executed too slowly, so meaning, let's say, you have to liquidate 1,000 stocks or 1,000 volume of, say, the S&P 500, then that might take you quite some time. And so while you were liquidating this, of course, the price of this will change. And so it will usually change in relatively unexpected ways. You know, we know that price movements roughly follow a geometric Brownian motion. And so you're basically not getting exactly the price that you expect. And that's called your volatility risk. Now, what's the cost of trading? In this paper, what they do is they basically say, well, we need to define what this is and we need to have a discussion around that. And basically what they say is it's a difference between the initial market value and the value realized after liquidation. That's pretty obvious. So you're basically saying, okay, my price that I want is $100. And, you know, I put on a few trades and I end up actually having executed all my trades, all my buy signals, let's say, at $101. So we have a 1% trading cost. Of course, this would be quite large, but just as an example. Now, mathematically, what they say here is that the trading cost is actually a random variable. So it cannot really be controlled as such. But what you can say is that this random variable actually has a dependency on the strategy that you use for liquidation. So while, and we will see this in a bit, while the actual trading costs are more or less random, they do follow some distribution that is determined by the strategy that you use to liquidate. And so when they talk about liquidation here, I should really add this. It means obviously you have a portfolio, say, of 1,000 stocks and you want to liquidate them, so you end up with zero. But it could also go the other way, just equally as much that you actually have zero of this stock in your portfolio and you actually want to buy, and then instead of liquidation, you're actually buying. So it's pretty much the same thing. It's just convenient to talk about liquidation because you have this scenario where you actually end up with zero, which is mathematically just a little bit more friendly to investigate. So one of the important parts of this, of course, is, as I said before, the market impact. So your trading costs obviously consist of commissions that you have to pay anyway, and they're fixed, so you don't have to worry about how much they will actually impact you. So that are pretty predictable. But the other thing is the market impact that you have in your trade, and that's much, much harder to predict. In fact, it's incredibly difficult to do this. And in general, you can mostly just really have a best guess of what the market impact will be and then tailor your trading strategies accordingly. So there's two types of market impact. One is a permanent market impact. And basically, it says here, the other participants will bid low for a sell program or offer high for buy program in proportion of the average rate we are trading. So basically, we get into the market, we move the market, and the market stays up where it is during the period while the trade is on. So when it says permanent market impact, actually refers to the trading period or to the period while you execute that trade. After the trade has fully executed, we actually really don't care about market impact anymore, so we leave that out. Now, there is also a temporary market impact, which means you have some of your slices of your trades are executed. It temporarily moves the market a little bit, and then the market just moves back to where it was. So that's effectively a temporary market impact. Sometimes you only also just change the volume on the bid or the offer and not even the price. That's indeed also part of market impact. Obviously, that impact is less noticeable because the price, in fact, doesn't change. And so it's a bit more obvious. But these two types of market impacts are important to consider when you actually build a model that you want to use to execute with the minimal transaction costs. So there's a few extreme cases that we can consider, of course, and one is basically minimum impact. So let's say we have a strategy and we want to have as little market impact as we possibly can. What we do is effectively we're just submitting trades to the market at a very low volume at a constant rate. And so let's say we have to liquidate 1,000. We will maybe submit a new order every 1 minute or so during the day. and then that order will get filled. Now, the problem with this, of course, is that if we do this, we will take a few hours to actually run this trade. And in this time, the price will significantly change. So we're quite exposed to volatility in our execution price. Now, the other extreme case is the minimum variance case, where basically we submit the order all at once. So it means we move the market quite significantly, because if the market is large and we have not enough volume on one level to fill your order, then you have to go to the next level and next level. And so we will actually move the price up or down, depending on which side we are on. However, the variance is really minimum because it's very limited to the market impact that we have. So we know if we do the market order or the trade right there, and then we know exactly what our trade will be. So if we end up with a minimum variance in what the trading costs or the trade price that we can expect. So there's basically these two things, the variance and the expectation of the final trading cost. And what we can do is we can actually generate a model from that, which is very similar to mean variance optimization. And I think most of you probably would have heard about this. It's basically, modern portfolio theory, where you say, okay, we have a utility function, and what we want is to have a portfolio which has a maximum expected return and a minimum variance. And so when we have a high return and a low variance, we usually end up with a good Sharpe ratio. So that's our main goal here. And interestingly, the same is also true for optimal execution in a slightly different way. So we want to have the minimum expected trading cost and the minimum variance. And so if you look at this equation, you can see it's pretty much the same optimization that we have for mean variance portfolio. Now, when we do this, we get this typical chart here that we also get for mean variance portfolios, where this black line here is the efficient frontier. And then we have a few interesting points here. So for example, this is basically the trivial portfolio, where we just add trades to the market without actually trying to move the, so this is the extreme case, the first extreme case, where we try not to move the market. And then the other case is A, where we go to the other extreme. So these are our two extreme cases. And the optimal execution strategy is here somewhere in the middle. So we've got these two extreme cases that I previously discussed. And then here in the middle, somewhere, we have this optimal execution strategy. And the question is, how can we actually come to this optimal execution strategy? Now, you can actually see here what this would look like. So you can see there's case C, case B, and case A. So case B is, if you look back, is this basically this trivial strategy where we just liquidate our position at a constant rate. And the case A is, the other extreme case. And then somewhere in between here, we have our optimum. So now the paper, if you have actually looked at it, is quite mathematical. So what they do is they define a utility function here, u of x, which is basically the function we like to minimize. And when you do this, you can formulate this stochastic differential equation here. And this differential equation looks quite daunting. In fact, it's not too bad, and you can solve it, for example, with several methods. There's one called backward induction, where you basically start with the end and then you back calculate what your optimal liquidation profile is. And I don't want to go too deep into this because it's not necessarily too relevant for what we're doing today. I have done this before, but I'm certainly not an expert on this topic. But what's actually really interesting is that this differential equation has a closed form solution. So it's actually got an analytical solution. And this is our analytical solution here. So it looks still a little bit daunting, but it's actually fairly straightforward. And so what this is sin h, which is just a simple mathematical function. And then we have t. This is basically the time that we think we want to execute. So let's say we say, well, our execution should last an hour. So We want our liquidation to go on for an hour or a day and so on. And then we have this TK here, which is basically the current time that has already passed. X is our current position size. So this is how large the size of the position that we currently have. This X bar, basically is where we want to go. So let's say when we have 1,000 in our portfolio and we want to go to 0, then this X bar is actually 0. So usually when we get a full liquidation and we set this to 0, then this term will become 0 and this will become 0 as well. So in fact, we end up simply with this one here, sin H, kappa T minus TK divided by sin H kappa T times X. That's it. So it's actually a fairly simple equation. And basically this XK here is the amount of stocks that we liquidate in the next period. So that we basically get from the current X to the next X. One thing that we're missing here still is this value kappa. And kappa is basically just one parameter that incorporates a lot of things, such as the two types of market impact, volatility, and so on. And you can see this here. It actually has our lambda in, and you remember lambda was a factor here in our utility model. And this factor just in mean variance optimization is actually called the risk aversion. And the way to think about risk aversion in some ways, it's a little bit the inverse of the Sharpe ratio. So basically it's a parameter that we can set to determine how fast our strategy should run. So let's say we run it with maximum risk aversion. That basically means we liquidate the portfolio all at once. So we do the straight away, the liquidation, everything goes. And so we basically have zero risk because we know exactly based on the current order book what our executed price will be. So at the current order book and of course the volumes in the order book. Now that's of course provided that the volumes that are in the order book that we try to execute are actually true volume and not some high frequency traders actually posting the volume there and just removing it as soon as you start trading, which unfortunately often happens. But you know, in many cases, we obviously have to simplify our assumptions a little bit. So this kappa incorporates this. And so the only parameter that we actually do set in this whole equation here is kappa. And that then determines our optimal execution profile. And so this is a typical example of this. So you can see A. And so when we set our kappa in a certain way, what we get is this interesting execution profile where at the beginning of our period, we're executing usually a larger proportion of our portfolio, or we're liquidating a larger proportion of our portfolio. And then as time goes on, we're actually liquidating less and less. And then right at the end of the time, we usually only have a few small positions left. So this A here is a typical profile. And I will show you actually some real life example in a little bit. So this is what this looks like. So this is basically that equation here, that profile that we've just seen. So in the paper, they have a test case. And I think what's important about this here is not so much the fact that this is a test case, but rather that it actually really explains all the different variables. So for me, when I go through papers often, and it's purely theoretical, sometimes I struggle to actually understand what the authors mean with all the variables or the constants that they give so that I can actually use them. And what I really love about this paper is that I actually defined all these constants that you can see in the mathematics of this liquidation profile, and you can actually use them. And so when you actually try this yourself, and I highly encourage you to do this, by the way, because it's a very, very interesting exercise and you will learn a lot about how trading works. And specifically, this sort of stuff also goes into the realm of high frequency trading. You know, when you do the HFT, you have to consider market impact and so on. So actually just taking those numbers and then see if you can plug them into the model that has been proposed in the paper and then do the calculations yourself is incredibly valuable. Now, here's some of my own personal trading results. And what's interesting is when you look at this profile, the theoretical trading profile that you see here, it looks fairly friendly, you know, and it's like, oh yeah, you know, it follows this, but in reality, it actually doesn't follow this. When we see this profile, this is just a statistical average of everything. And this is really quite interesting to see here, because here I did a whole lot of trades, probably about 50 or so. And I start with a position of 100. And then I basically run this execution profile. It's also, when you write this as an algorithm, it's actually called the arrival price algorithm. So I run this arrival price algorithm through a number of trades. And what you can see here, some of these trades, they get executed really, really quickly. They go through really fast, and some of them take quite a bit longer. You can see here, this one has actually taken quite a bit of time, and it's really just closing out right at the end. But what's really interesting is when you take all these trades and you take an average of all the executed volumes, you can actually see this purple curve here. And when you fit this purple curve with the model that I've just shown you with the SynH one, it actually fits perfectly. So when we're just executing, say, a volume of 100, while we're not seeing like this same smooth curve, when we do this over and over again, on average, we will actually get exactly that profile. And that's really interesting. And what's also interesting about this, if you look at these trades, and for example, you do the same, you mirror those trades and you mirror them with the two extreme cases that I've presented you, one where you execute the full order instantaneously at market, or one where you just submit new orders at a constant rate to the market, you will find that overall, the execution costs of this are significantly lower than with the two other extreme cases. So that's really the proof that this optimal execution stuff actually works. And I find that really interesting. And even, you know, if you're trading for yourself at home and maybe you're into small caps, and maybe, you know, you have a small cap where the prices are really low as well, and all you want to trade is maybe $500 worth, and you've got just, let's say, $5 per stock, and you've got this 100 stocks, then this could already be fairly handy. And as you probably know from your own backtests, you know, trading costs can really make or break your strategy. So any chance to reduce trading costs in any meaningful way are always extremely welcome and extremely helpful. And this whole work that I'm showing you here in this paper, this is really the basis of the idea of how can we find the best possible way to actually save trading costs.
I do have a question. I want to know, how were you able to get this plot in general? Did you have to get a couple of the parameters like volume, and how were you able to get it? I really want to know. Did you plug
So,
it into the formula in order to generate this plot?
okay. So what I did is I basically have my trading account. I'll pick a stock. I'll say, okay, I liquidate 100 positions of that stock, right? I put on the arrival or this algorithm that I built, you know, the arrival price algorithm or the Almgren-Kris model. I determine the parameters of the market in that moment by some equation that I have. Basically, it's also described in the paper how you can do this. So there's many different ways of doing it. I basically just set this kappa parameter the way I think I want it. And then I just let the algo run until my whole portfolio is liquidated. And so I basically get these curves, which basically show me at what time during the trade, and you see here the trade lasts for 5 minutes, we had how much volume. And then all I do is effectively just, once my order gets filled and so on, I just move on. And so you can see that we're basically sometimes getting filled much, much quicker than other times and so on. And we're basically supplying orders to the market that will get filled. And depending on how quickly they get filled, we're basically adapting the algorithm to that. Does that make sense? Is it what actually answers your question?
Yeah, I think it does. I think it does. I just want to
Okay.
have like a high level understanding about how you went about it. At
Yeah,
this
yeah.
at this line, no, it's not like you got it from the broker. You had something you had to, generate yourself. based on the understanding you have about the model. Thank you.
Yeah, so this is basically a typical arrival price algorithm based on the Almgren-Kris model, and it's just purely from my own practical trading. So what you see here also is the blue line is basically the average of all the data points at any given time step.
Cool.
Yeah. Okay.
I had
So
another question.
sure, go for it. Yeah.
Yeah, I wanted to ask more about the kappa variable. I'm not sure I quite
Yeah.
understood what that is exactly. Could you explain that further?
Yeah, so kappa is basically a combination of various things pertaining to the market. So for example, it could be permanent market impact, temporary market impact, volatility. Your risk aversion parameter also flows into that. Now, in many practical applications, so let's say you go to Interactive Brokers and you fire up the arrival price algorithm that they provide, there is actually a parameter that needs to be set where it says aggressive, passive, or medium or something like this. And so basically this parameter is kappa. So what you could actually say is if you set your kappa really, really high, then you get quite aggressive. And then your arrival price curve will basically be much steeper at the beginning. So it goes really steep down and then flattens out quite a bit towards the end. Whereas if you have a much more passive scenario, you either get a straight line here, or even beyond the straight line, you get actually a curve that curves in the other direction, like this. So you basically go from concave to convex, if you will. So this kappa really is, in some sense, a parameter that sets the aggressiveness of your trade. So if you want to be less aggressive, you change the parameter to a different value. Does that make sense? Does it help you?
Yeah, that makes sense. So
Okay.
the higher it is, the more aggressive, or the lower.
Well, it actually depends how you set it. So normally when you set it higher, you become more aggressive, and when you set it lower, you're actually less aggressive. Now, in many algorithms that you can use out of the box, you don't actually set this as a parameter. You literally just set very aggressive, slightly aggressive, medium, and then passive or very passive. And yeah, for example, if you want to, liquidate, and you have a feeling that while you're liquidating, the market goes in your direction, you probably want to be more passive, because you think, well, if the market moves in my direction and I just sit it out and wait, then, I can probably get a better price in my trade. But let's say the market is just about to correct and it's tanking and it's really scary, you probably want to be very aggressive, because you expect the market go completely against you, and you want to get out of your trade as quickly as possible before even more damage can occur. So they're really the two extreme scenarios here. So yeah, if you have any more questions to this, of course, we all have different levels of understanding, and if you feel like, oh, maybe I struggle a bit with the understanding, please feel free to ask. That's why we're doing these sessions.
I was just wondering, the times you sent your order out, like the time selection, was that random itself, or is that somehow captured in this kappa variable?
It's not really. So what you normally do is, there's a few things that you usually build into your algorithm as well. So for example, liquidity and so on. So if the liquidity is really high and it looks like, your market impact is not particularly large, what you often can do is just like be a lot more aggressive, because there's no need to sit around and wait. If you can execute at the price level that you want, you don't really need to do anything. And so this equation is really just the guiding principle at which your liquidation takes place. But of course, the algorithm that you build around it, depends on your own implementation. So for example, you can make the algorithm such that as soon as an order gets executed, you follow up with the next one, sort of a bit like an iceberg thing, or you can test the market at regular intervals and so on. So there's many different ways you can actually implement it. And that's not really part of what they say in this paper, how you actually implement it. What they're really talking about is, okay, this is the best way to minimize expected trading costs and expected variance. And so how you implement this in an algorithm is then yet another story. Now, in many cases, if we're traders, we don't necessarily have to do this ourselves. We can actually use, for example, the arrival price algorithm from Interactive. No, I'm just saying I'm not affiliated with Interactive Brokers. It's just a broker that I use quite a bit for my personal trading, so I know more about it than other brokers. But so arrival price algorithms are usually supplied by a broker, and quite often people just use them. They don't actually have really much understanding of what they're doing. But learning about this, for example, gives you a much better understanding, which also means you can actually set the parameters in a more informed way and use those algorithms more selectively in order to get the best possible outcomes. So, yeah.
I have a kind of related question. So if you're using one of these sort of available strategies like arrival time, they're parameterized. In practice, do you adjust the parameters in order to get closer to the efficient frontier for your trades?
Do you mean adjust the parameters during the trade or beforehand?
I was thinking beforehand, sort of you have your chart of your historical trades and the average.
Yes.
Do you find that you need to update it?
Absolutely. So there's several ways to adjust the parameters. You can do this by hand. You could say, well, quite often that's what happens in big institutions. If you have to execute a big trade, you just go, okay, I've got the experience. I kind of know what the market looks like. I set this parameter in a specific way. However, there's also ways of actually automating the setting of the parameters. For example, using Kalman filters, machine learning, and so on. So yes, the parameter ideally should be set every single time in a slightly different way depending on the market. And I told you that, for example, if we expect the market to move in your favor, then you probably want to be less aggressive. But if the market moves against you, then you want to be more aggressive. So that's already an important case where you go, okay, I want to set my parameters differently depending on what I expect the market to do. Make sense?
Yeah, for sure. I do.
Answer your question? Okay, great. So basically, when you go through the paper and you look at the mathematics, the equation that I showed you, the analytical is probably the centerpiece of the paper. And then, there's a few other things, of course, that they talk around, which are obviously important, but not quite so important. So I don't want to go too deep into discussion of this, but I want to give you a few more quotes from the paper that I think are really, really interesting and important. And this one here is, first we observe that because the set of attainable strategies, hence the efficient frontier, are generally smooth and convex, a trader who is at all risk averse should never trade according to the naive strategy of minimizing expected costs. Again, the naive strategy is basically the B here. So you should never do this. This is because in the neighborhood of that strategy, a first order reduction in variance can be obtained at the cost of only a second order increase in expected cost. So what I'm saying here is basically if you have B and you go to A, you actually only have a smaller expected loss, but you actually have a much, much larger reduction in expected variance for your optimal strategy. So ultimately, your execution will in fact perform generally much, much better when you go from this naive way of liquidating or building up positions to this more sophisticated ways of using the Armstrong-Chris model, for example. So you can see this here. So basically we're going from B to A. We only have a small increase in our expected trading loss, but a really, really large decrease in the variance. And that's really, really crucial here. And that's what the authors are pointing to. Now, there's a few other really interesting things that we are told, and I want to talk you through it here. So they say, finally, let us point out subtleties of this problem, which suggests the direction of future research. the strategy we have considered here are not adapted to the random motions of the stock during liquidation. So basically, what they're saying is that with the model at hand, the model they described in the paper, and don't forget this was the first paper on this sort of topic that really stands out. They're saying, well, you have to set your parameters before you do the trade, and you should not actually change the parameters during the trade. So once you've actually set your parameters and they're optimized, you should actually stick with that. Otherwise, you cannot guarantee that you will actually get optimal execution anymore. So that's only really, if you have a view on the market, you determine that beforehand and then you stop. And then they say, however, for strategies selected according to the criterion of value at risk, the situation is much more complicated. If the trader reevaluates the strategy halfway through the liquidation, he generally will wish to choose a different strategy for the remaining one. So basically what they're saying here is, just if you think, oh, the market goes in the direction that I didn't expect, I should really change my strategy. That's a really bad idea. You should not do that. You should actually stay with what you determined beforehand. And he say, however, viewed from the initial time, the analysis we have proposed is the best that can be done. So once you stick with the initial time and you do this, you actually get the best out of it. Now, that is not to say that there aren't actually any better algorithms where you can adapt your parameters during the algorithm is running. Now they do exist, and I have actually worked with them. The problem with those is they're all based on the same principle of the Almgren-Kris model, but they are way more complex and they do not have any analytical solutions. So if you want to trade them, what you actually do is every time you want to update your model, you actually need to solve a set of partial differential stochastic equations numerically. And that can become, mathematically a little bit more involved. For me, this is also pushing me definitely to the boundaries of my mathematical understanding, but I have managed to implement some of these strategies, and they're very interesting. Now, specifically, one strategy that I have built was a strategy that uses market and limit orders at the same time, and then it chooses whether it should actually just sit there with a limit order and wait for the market to basically execute that limit order, or if you are behind in actually executing your optimal execution trajectory, at some point you can actually run a market order and you basically go more aggressive, and that brings you back to your optimal execution curve. So these models exist as well, and there's actually 2 interesting books on that. And so for more of a deeper understanding of this Almgren-Kris framework, I recommend this book, Oliver Giant, The Financial Mathematics of Market Liquidity. So we'll find some much more in-depth explanations there that the paper can give you or I can give you. And it's a really good book to read, but it's quite heavy on the mathematics. And the other one that I really like is Alvaro Cartea, Jamingual, and Penalva, Algorithmic and High Frequency Trading. So just what I explained to you, these more advanced models based on Almgren-Kris framework, where you actually have limit and market orders in conjunction, they're all explained in this book here, Algorithmic and High Frequency Trading. So they talk a lot about optimal execution, but they also in this book talk about the mathematics of market making. You may have heard of the Avellaneda-Stoikov model, which is the sort of basic market making model that people use. So that's also discussed in this book. It's a really good book, again, quite mathematical, but actually really good fun to read and really interesting when you actually grind your head into it. So that really concludes my presentation for today, and there's question time. So please feel free to ask me any questions. If it's somewhat unrelated, please ask it as well, and I can probably give you an answer too. So thanks for listening, and yeah, let's please fire away some of your questions if you have any.
Yeah, I had a question.
Sure, go for it.
So how would you recommend that, let's say, because when I read the paper initially, I really struggled with the mathematics, obviously, of it.
Mm-hmm.
And
Sure.
how do you go about kind of improving that part of your understanding? Is there any kind of process that you would recommend? Or
I can tell you, Nicholas, quite frankly, I have the same problem. I mean, I know a decent amount of mathematics, but you know, a lot of these things are often also quite new fields to me, and I don't necessarily understand them. And so what I normally do is, and specifically with this problem, I actually started implementing, first of all, the analytical solution just to see what it does. And that's not too difficult. You know, it's just a simple equation. And so I first start with that. And then what I do is I look into those differential equations and I go, okay, you know, that's tricky. Now you need a little bit of a math background to get a sense of how you solve that. There's actually quite a lot of interesting literature on how to solve those types of equations. And the other thing that you can also do is quite often you find on GitHub, people have already solved similar problems. So you can go and maybe use or reuse some of their approaches and codes. There's actually several ways you can solve these equations. You can, for example, use Monte Carlo simulations. You can use dynamic programming. It's basically a solution of it's like a backward induction of Bellman equation. You can also use something like finite element methods. And they're all actually quite different ways of solving those. And the main thing is when you start doing this to familiarize yourself with learning how to effectively solve differential equations. I mean, it's not an easy feat if you're not a mathematician generally. And the more you do it, the more you learn. So what I was doing really was I started more or less from scratch as well. And I just started with something simple. And I looked, you know, some really basic stochastic equations. How can I solve them? And then, you know, become more and more, go deeper into the subject. And once you've done this a few times, you actually can really see the pattern. And then it's much, much easier to tackle those problems. But yeah, it's not easy. But you know, if it was easy, everyone would do it, and everyone would be in the market. There wouldn't be any money to be made. It's the barrier to entry that makes it interesting. And some of the alpha in those situations actually comes from the barrier of entry, from the difficulty for people to actually do something. So if you want to be good at this, you just have to effectively cross that barrier and do it. So yeah. I'm pretty sure you can if you apply your head. It worked for me, so I'm pretty sure it works for anyone else too. All right. Any more questions? Any other questions?
I have a question.
Sure, go for it.
First, thank you for the presentation. It was really, really cool. Learned a lot. My question is this. As I understood the algorithm, my intuition was telling me if we want to minimize the market impact cost, wouldn't it be important to know the order book? Because if we knew exactly the orders that are in the queue, we could be opportunistically, like, take the opportunity whenever there's orders that can help us and be less aggressive when it is not, but based on the order book. And I mean, my question is around, the order book, because I think if we could look at it, we could minimize further the cost. Doesn't that make sense?
Absolutely, Carlos. Basically, what this did is provide a mathematical framework of how you get it started. But the amount of details that you can add to this are quite infinite almost. So, you know, the simplest way to do this is to literally just look at the market and say, okay, I want to be more aggressive with this order or more passive. That's like the absolute base level. But you're absolutely right. If you want to do this extremely efficient, and for example, high frequency trading companies, that's what they do. They really look at the fine-grained level 2 or even level 3 order book in order to basically get a sense of, okay, what does my quote size needs to be? Where do I need to place it? When do I need to be aggressive and so on? So this base model is really providing you the overall framework of thinking about it. And then there is the next level, which comes when you implement it. And so, for example, I said that, the parameter kappa that you use is, in the simplest sense, a level or a marker of aggressiveness. But that kappa itself can be determined, for example, by the shape of the order book. So when you read the book by Cartea that I just earlier showed you, what they do is they actually look at the shape of the order book. They basically build a sort of exponential function proxy for the shape of the order book. So they fit their function to the order book and calculate the shape. And then they use that as part of the input parameter in this equation. And this is how they effectively calculate their kappas. And, even the shape of the order book can still be a fairly crude way of doing it. You could go even deeper and you could say, well, what if, for example, I use machine learning to determine my kappa based on all the levels of the order book and the volumes, and I feed this, say, into a neural network, and then the neural network spits out my kappa that I need to use based on previous learning. So there's many, many ways you can add details to this algorithm. So this paper was really just providing the initial way of even thinking about how you approach optimal execution. And from there on, this whole kind of worms opened up where you can then go into all types of depth and detail. Good. Okay. Hope that answers your question. Anyone else? Any more questions? No. So I thank you again very much for coming along. If you have any more questions, probably an easy way to reach me is on LinkedIn. That's usually something I check more frequently than other things. I'm a busy guy. If you have any questions, just send them to me, but make sure you formulate them well so I don't have to guess what you actually mean. That helps. And otherwise, I wish you really happy trading, an interesting experience in your journey. And I hope I see you in the next session sometime.